or we can invest 2 million baht in the project. That's totally okay with us previously. Okay. Now, today, we are going to say that the company has certain amount of capital to be invested. So the firm may not be able to invest in all of the projects available. This is the case of capital rationing. So we need to ration or divide the money wisely in order to, again, maximize shareholders wealth. Okay. Now, let's look at exercise here, okay, on the following page. You are given 5 projects altogether, and these are the cash flows. We are going to make the decision at 11.75%. Okay. In case the question just stop at this one, so we calculate NPV of each project, right? And which project NPV is greater than or equal to 0, we are going to accept that project, and so on. This is what we discussed earlier. Now, for today, we are going to invest in these 5 projects with only 81,000 baht. Now, you may see that when we have only 81,000 baht, we cannot invest in all of that. Since when we add up initial investment together, it will go beyond 81,000. You may see that in case we invest in project E only, the rest the firm cannot invest in it because the firm used up its capital already. Okay. Somehow, before we are going to do, let's find out first, okay, all of these 5 projects, which project give us NPV greater than or equal to 0. So we can, if it's possible, we can cut some project out when they give us negative NPV, right? So first, please calculate NPV of these 5 projects, okay? And let's see. Okay, right? These are the answers. Okay. So, according to NPV, which project NPV suggests us to invest? Project E, right? The highest NPV project. Okay? So, based on NPV, this is what we are going to invest. Are there anything wrong with that? Okay. The answer is no. We invest 81,000, right? And then this project E just increased the wealth of our shareholders to 82,224. This is what we have, according to NPV. The amount of NPV is increase in wealth that we discussed earlier. This is totally okay at this moment. Okay. Now, for capital rationing, okay, when we invest in project E, and remember our initial investment in year 0, we need to invest 81,000, and what we have only what 81,000 baht available this year. So even though the firm has 5 projects, all of them NPV greater than or equal to 0, in general case, the firm should invest in all of that. But today, the firm has only 81,000. So the firm will invest in project E, and then the firm will throw the rest away. Get the point, right? This is what we have. Now, the problem of NPV is like this. NPV will give you almost correct decisions in most of the situations, except few of them. Okay? Few situations that we are going to have better answer. Okay? Even though the answer must be confirmed by NPV, but NPV solely will not help us that much. Okay? This is the case. You may see that when the firm has 81,000 to be invested, how many possibilities that we can use 81,000? First, we know that we are going to invest in project E only, right? Okay. What else? The firm can use 81,000 to invest in what? A, B, and C. Get it right? So A plus B plus C. What else? A and C, right? Sorry, A and D, right? Okay, and B, D. Finally, C plus D. Get it right? So with 81,000, there are 5 possibilities for the firm to utilize this amount, 81,000. And investing in project E only is just one situation. Nothing wrong with that, but the answer is not good enough for investing in project E. Because another choice will give us what? Will give us better answer. Okay? Which one? The other choice that gives us better answer. Which case? A, B, and C, right? Because A, B, and C, when we invest in project A, B, and C together, we are going to get total NPV of these 3. And you may see that when you add them up, it is greater than 82,000 something. Is it okay? So, this is what you need to beware when you use NPV. When you use NPV in the capital rationing case, or when you have limited amount of money to be invested, NPV may not give you the best answer. Since in general, NPV that we look at it, we will invest in the highest NPV project first. Okay, we are not going to go with that decision. Okay, so for this case, okay, what we should do? In terms of capital rationing, or we have limited amount of money to be invested, we are going to invest in a group of projects that give us total highest NPV. Is it okay? We are going to invest in what? A group of projects that give us the total highest NPV. And from this one, this example, you may notice that projects that we put in the group may not necessarily to include the project with highest NPV. Right? Okay. Now, remember, right? NPV is the hero of the story that I usually compare with Batman. Right? And again, I just asked you that some episodes Batman also failed. This is the case because NPV will not give you the best answer. The answer for project E is good but not the best. Because it will not follow the objective to maximize shareholders' wealth. Okay? Now, if Batman failed, there must be someone to help it, right? So the real Robin who helped Batman in this case is profitability index. Okay. Go back and compute PI by yourself for these 5 projects. You are going to see that the project that we accept A, B, and C, at least one project must give us higher PI compared to PI of project E. Why? Why PI just get the part in this situation? Because what PI try to do for you? Divide what by what? Your numerator is the present value of cash outflows, right? Divided by present value of cash outflow. Okay? So when we have limited amount of money to be invested, we tend to invest in what? The highest PI project first. Because of what? We pay 1 baht in denominator, right? We will get what? The highest cash inflow from numerator. This is what PI tell you. Okay? So I just let you prove it by yourself that when you calculate 5 of these projects, PI, okay, of project E is not the highest PI among 5 projects. That's why we are going to go for other project first. Okay. And remember, PI just help you, okay? Just help you to find out which project you are going to accept. Somehow, toward the end of your conclusion, you must prove that adding up NPV of the projects you accept, total NPV must be the highest. PI is not enough. PI just help you along the way. But you must confirm that this is the best scenario compared to the rest. Because the rest, total NPV must be less than this one. Okay? This is what you need to prove at the end. Any question for capital rationing? Is it okay? This is the most difficult topic in this section note because the situation may be even more complex, like what you see on the next page. This is one of the very difficult examples when you just use what we know at this moment. Okay? You have 6 projects altogether, and some project, it may not start today. And for these 5 years, you have only, I think, 150,000 to be invested. Okay, here. Okay, so in this case, what you are going to invest here, you need to get the help of the idea called linear programming. Okay, I think you know how to do it from another course, right? So you set the objective that you would like to maximize shareholders where when you sum up NPV must be the highest, and you solve the proportion that you invest in each project. Okay, so one way to do this, you may put in Excel spreadsheet, okay, and use the function called solver to solve for it. I just give you the process in case anyone would like to do it, and you are going to get the answer from here. Okay, this is what we have. Okay, just give you the idea that the situation for capital rationing may be very complex like this. Okay, the second topic for special issues, it is comparing projects with unequal life. Okay, I think I need to add the topic here. Okay, must be comparing project with unequal life in mutually exclusive environment. So for this topic, you are going to use it only if 2 conditions must be met. First one, you must be in mutually exclusive environment. You need to select one project from all. And the second condition is that the projects that you are going to pick one out of all of them, there must be at least 2 projects with different life. Okay. Previously, when we see 2 projects with different life, okay, I just ask you to notice that when you have 2 projects with different life and in mutually exclusive environment, you are not going to compare 2 projects that has different life like this. Okay, because of what? Okay, when you have 2 projects like this and they are what? 6 years versus 3 years like this. So what happened? In case you calculate NPV, just the regular NPV, you tend to select the project with the longer life because the project with the longer life give you what? More cash flows, right? So you are going to have what? Longer life project give you more cash flow in general compared to the shorter life. So when you compare project, the longer life and shorter life like this, you tend to select the project with longer life. Usually this is the case. Okay? But it may not be fair for the project with the shorter life to be compared with the longer life project like this. So we must have some method to compare these two. Okay? Before we go to that, let's look at this situation. The company is planning to modernize its production facilities, and it is considered to use either system, conveyor system or forklift. And this is mutually exclusive environment because when the company install the conveyor, this is the conveyor look like. Okay? It just be the situation where the company would like to move, let's say, the product from point A to point B. So there are two systems that the company may apply. First one, conveyor. Just put the product on conveyor and let it move to the other point. This is one way to do it. Or the second way, this is the forklift. You just put the product on the fork, right? And then just drive this truck to somewhere else and then put it out. So when the company use the forklift, the company will not need to install conveyor. And the other way around, when the company install conveyor, the company need not to use the forklift. Get it right? So it's totally, strictly, mutually exclusive like that. Now, when we compare two projects with different life like this, okay, we must have the certain method to compare it. There are two ways to do it. First one, we are going to use the concept of replacement chain method. Okay, what replacement chain look like? Okay. This is how we do it. Okay. For replacement chain, okay, this is conveyor project cash flow. This is forklift. So we invest what, 25,000, right? And we get 20,000, 23,000, and 26,000 like this. This is forklift. Okay. For replacement chain method, what we will do is that first, okay, we are going to replace or invest in shorter life project. Okay. You must invest in whole project. Okay. Until all projects life equal. This is what you will do. Okay? You are going to reinvest or replace, or you may put repeat the project. Okay? Replace or repeat or invest in project until project life equal to each other. This is the process of replacement chain method. Okay. This is how we do it. For replacement chain, you are going to repeat the project until project life equal to each other like this. Okay? So for forklift, it is the shorter life project right here, forklift. Okay. So after the project ended, we are going to repeat or replace. Okay? So we are going to somewhat like invest in this project one more round. And for simplicity, we just assume that cash flow from the project, they look the same. So we are going to purchase another forklift at the end of year 3. After we purchase the second forklift at the end of year 3, we can use it for the next 3 years, right? Because the project life equal to 3 years. So you need to invest or repeat the whole project life. Assuming that the cash flows look the same. So minus 25,000, 20,000 happened in year 4. 23,000 happened in year 5. And 26,000 happened in year 6. So the cash flow in year 3 just turned to be only 1,000. That's it, okay? This is what we do. After we repeat it for just one round, the forklift project, we have what? The same length of life equal to conveyor. Now you can compare them. So we calculate NPV of conveyor, okay, and calculate NPV for forklift twice. And which one gives us the higher NPV, we are going to accept that project. This is what replacement change method try to tell us to do. Any question for this one? Okay, please calculate NPV. Okay, for these two, and give me the idea which project you are going to accept. Okay. So this is the fair case, right? So if somebody like we compare two projects with same life, okay, same maturity. Right? These are the answers. So the forklift must be selected, not the conveyor. Any questions for this one? The replacement change method. Now, let me ask you this. In case two projects that you have look like this. Project A, 4 years. Project B, 3 years. What replacement chain method you need to apply here? We repeat which project? The chapter line project, right? Project B, okay? And when you repeat the project, you need to replace or repeat the whole project. So you need to add another 3 years. So you have 6 years altogether, okay? Now, can you compare 4 years project life with 6 years project life? No. So what you need to do? You need to replace the chapter line project, right? So you add another 4 equal to 8 years. Are they equal to each other? No. So what you need to do? Repeat this one again to be 9 years. This one becomes chapter again, right? So you repeat this one, another 4 equal to 12 years. So finally, it will go to 12 years altogether like this. So you need to repeat project A for 3 rounds and project B for 4 rounds like this in order to get the same project life. This is the process. Okay. Is it okay? This is okay. And it will be a very long process for replacement chain. Okay. Now, are there any other methods to compare two projects with different life in mutually exclusive environment? The answer is yes. Okay. Another method is where we call equivalent annual annuity that I put above here. Okay. Equivalent annual annuity or EAA method. Okay. For EAA method, this is what we will do. For EAA, okay, for each project. So first, okay, you calculate regular NPV. Okay. After that, you just put NPV as if you have the present value at time 0. Okay. Then you compute annuity from present value here. Okay? That annuity is what we call equivalent annual annuity or EAA. Okay? Then we are going to select project with highest or higher EAA. Okay? This is the process. For each project, compute the regular NPV. Regular NPV means based on its original life. And after you get that, you just put it as the present value. In fact, NPV is the present value, right? You just compute annuity. Remember, annuity is what? Same amount of cash flow year by year, period by period, right? From that NPV or that present value. After you have EAA, that annuity for each project, you are going to select the project with highest EAA or cash flow per year. This is EAA means. Okay. So in our case, okay, let's look at conveyor and forklift one more time. This one. For conveyor and forklift, okay, I just compute EAA for conveyor first, and I have NPV previously for conveyor, right, which equal to 29,141.7632. Okay? So I just put this one as the present value. Okay. What I need to do, when I have the present value here, I would like to compute annuity or cash flow per year for 6 years, right? Equal to 1. And for today, rather than we call them cash flow, we are going to call them EAA. Okay? So change this one to EAA instead. It just be the very same variable as annuity that we know so far. So what we have, okay, 29,141.7632 equal to what? Equal to EAA, right? So you get EAA for conveyor. And keep it first, okay? Repeat the process with forklift. And compare EAA, which project give you higher EAA, select that project. And remember, from our replacement chain method, we select forklift project, right? We just look at the very same 2 projects. So I expect that the conclusion must be selecting the forklift as well. Or EAA of the forklift should be higher. Any question for this method? Okay, please calculate EAA for conveyor and also calculate EAA for forklift. Okay, fine. Get the answer here? For forklift and conveyor, these are EAA. Any question for the process to compute EAA and the computation here? Okay, the next issue for this lecture note or the last topic of this lecture note, we are talking about economic life versus the physical life here. Okay. For economic life versus physical life, what does it mean? Physical life is the length of the life of non-current asset. Okay. When you invest in a project, you invest in, let's say, equipment. And let's assume that equipment has useful life, let's say 10 years. So for useful life 10 years, previously we just assumed that we are going to invest in the project for 10 years, equal to the useful life of your asset. Okay? This is what we call useful life, or physical life here. Okay? Now, in this example, let's assume that the physical life or useful life equal to 5 years because we rent a space for 5 years. And the rent contract that we sign here, it is what we call irrevocable. Irrevocable means that your rent contract cannot be terminated before 5 years. So you need to rent the place until year 5. Okay. In other words, for physical life or useful life, we are going to do this project for 5 years exactly. This is what we call for useful life, physical life. Now, can we just stop the project before 5 years? In fact, in reality, we can do. For example, I signed the rent for 5 years. I invest 70,000 already. 1 year after that, I earn the cash flow 17,000. In fact, I can go on with this project for the next 4 years, right? But at the end of year 1, I just think that, okay, I don't want to do this project any longer. Still, the rent contract need to go on for 4 years, right? So what should we do? Okay, I will ask someone to purchase this project from me and let that person go on with this project for the next 4 years. Get it, right? This is what we call economic life. So in this project, economic life in this case just equal to 1 year. Even though useful life or physical life 5 years, we are going to invest in just 1 year. And we are going to sell at the end of year 1. So you may notice that economic life is not only 1 year. In this case, economic life can be 1 year, 2 years, 3 years, or 4 years. Okay? It depends on how long you are going to invest in this project by yourself and when you are going to sell it. And let's assume that the salvage value in the next column. This is the market value or proceed you get from each year that you sell the project. In case you sell your project in year 1, you are going to get 72,000. In case you sell your project in year 2, you are going to get what? 69,000 like this. This is what we have. Okay, so the decision in this project return to be 5 different cases. Okay, case number 1. You may invest in this project for yourself equal to the physical life or 5 years. Okay, you invest 70,000, you get 17,000. 19,000, 20,000, 21,000, and 30,000 like this. Okay, so you get NPV of this case. NPV of this one, just be NPV in case that you invest for 5 years. So you get which NPV equal to what? Just calculate that. And then for economic life, it will be like case number 2. Okay. You may invest in just 1 year, 70,000. You get cash flow in year 1, 70,000, plus the selling price because you sell it after you operate for 1 year. Okay, you get 72,000. So finally, your total cash flow will be 89,000, and the project life equal to 1 year only. Okay. Or you go to case number 3. You invest for 2 years by yourself. Invest 70,000. You earn cash flow in year 1, 70,000. Year 2, 19,000. After that, you sell it immediately, so you get 69,000. So cash flow in year 2 just turned to be 88,000 like this. So in this project, you are going to get more than 1 NPV. You get NPV for 4 years, you get NPV for 3 years investment, you get NPV for 2-year investment, you get NPV for 1 year investment, and in this case, okay, you are going to accept the highest NPV again, and you will know that how long you must do this project, and it may not necessarily to be 5 years, equal to the physical life.ไม่เห็นนะเราเลื่อนหน้ามันก็ไม่เห็นนะไปนั่งไกลหน่อยนะได้ไหม It's either I zoom in or you zoom yourself. Here. Okay, calculate these 5 NPVs and tell me how long you require to invest in this project. So these are the answers. And I think the best year for us to invest in this project is 2 years. Right? Invest for 2 years. And you may notice that you are not going to invest in this project for the physical life for sure. Okay, after you get all the answers. Yes, you are correct. You write it down. Okay. If you calculate it, you know what I'm talking about. Okay, any question for this case, economic life versus physical life? Is it okay? Okay, now we are going to compute the cash flows. So the next lecture note is where we call cash flow estimation. Now, for the cash flow estimation, please skip the first few pages. Okay. Go to page 4. Forecasting project cash flow first. Okay? Now, when we have a project, cash flow year by year in the project life can be divided into 3 sections. Okay? The first section of the cash flow is what we call initial investment or investment outlay. Okay? Or initial outlay. Okay? This is usually cash flow in year 0 when we invest in it. Okay. The second part, you are going to get the second section of the cash flows called operating cash flows, which will come to you annually or each year in the project life, year 1, year 2, year 3, and so on. By short, we call it as OCF. Okay? Now, after that, you are going to get the third section of the cash flows called terminal cash flow. So there are 3 sections altogether: initial investment, operating cash flow, and terminal cash flow, like this. Now, in terms of your timeline, okay. Previously, this is what the timeline looked like, right? So you have cash flow 0, cash flow in year 1, cash flow in year 2, in year 3, and so on. Let's say you have n year project life, so you have cash flow last year. Okay. Now, for cash flow estimation, okay, you are going to get 3 sections of the cash flows. So 3 sections of the cash flows can be divided like this. This is section 1, initial investment. Okay. Section 2, okay, cash flows in each year. So we call it OCF. OCF year before last year, and OCF for last year. Okay. Then you have the terminal cash flows. This is cash flow of the third section here. Okay. Put them all together you can calculate NPV like this. Okay? So NPV equal to cash flow 0. Then you discount operating cash flows in each year. This is the pattern when we calculate NPV for the project. This is what we have. And I am going to give you the concept for each section of the cash flows. After I give you all the concept, I will give you time to calculate the numbers after that. But grasp the concept first, okay? You may notice that only last year we have two amounts of cash flows together. Okay? Operating cash flow in last year, cash flow M. And also, last year, you have another amount called terminal cash flows. Sum them up to the total cash flows for last year of a project. And this coming back. This is what we have. You see the sequence, what we talk about here, right? Okay. First, we talk about last lecture note, how to compute payback period, discounted payback period, NPV, and so on. Okay. In last lecture note, you are given all the cash flows. For this lecture note, or after this, I may not need to give you the cash flows. You must calculate the cash flow by yourself before you calculate NPV or IRR or PI or MIR for me. Okay? This is the second step that we are going to talk about. The next one, the next lecture note that we follow this, okay, you are going to learn how your discount rate comes from okay, required return. There will be link from one lecture note to the other, starting from the previous one. Okay? Okay, now let's go one by one. The first one, initial investment, this one, right? In year 0. Initial investment. For initial investment, let's talk about restaurant. Okay, if the project is restaurant, I would like to open a restaurant. What I need to invest at year 0? I need to purchase what? Land, right? I need to purchase building. I need to purchase equipment in the kitchen, like refrigerator, oven, stove, dishes, table, and so on. This is what I need for my restaurant. So first, initial investment must include, okay, investment in non-current asset. In terms of your accounting book, you call this one as PPE, right? Property, land, property, equipment, tools, and so on. This is what you invest. This is long-term asset that you invest. Okay? Let's assume that I invest for, let's say, 1 million baht. After that, okay, let's imagine my restaurant. I have table, dishes, fork, spoon, refrigerator, building, everything ready. Okay? Can I serve the first plate of food to my customer? The answer is no. Because I have refrigerator, I have oven, I have stove, I have table, I have dish, but I have no food on the dish. Get it right? Okay? These are the long-term assets only. I never have what? Inventory or the food on the plate yet. Okay? Inventory is part of what we call net operating working capital. So you need to invest, okay, investment in what we call net operating working capital. For net operating working capital, this one you may call it initial investment, okay, initial investment in net operating working capital. For net operating working capital in finance, we just abbreviate as NOWC. So sometimes I just call it initial NOWC, just that. So let's assume that I invest 100,000 baht. Okay? Example for net operating working capital, it's like inventory. But it is not only inventory, it also includes other things apart from inventory. Okay. For restaurant, inventory is the very easy example that I can put it for you. I would like to open a restaurant. I have building, everything ready, but I need inventory. Comparable to, let's say, you would like to open the shop to sell something that is not food. Okay? When you open the shop to sell, let's say, dolls, what you need, you have the building. Okay? You put on air condition in your building. You have a showcase to put your dolls on. Okay? These are investment in non-current assets. But if you have only that, you cannot sell any dolls because you haven't purchased dolls to be your inventory yet. So another part of your investment is this one. So you need to purchase dolls, your inventory like that. Okay? Now, before I explain operating cash flow year by year, okay, let me talk about net operating working capital first. Because net operating working capital, it has a very specific nature. Okay? So let's talk about this one at this moment. For net operating working capital, remember 100,000, right? Okay? So this is what we have in terms of net operating working capital in year 0. Okay? So we have cash equal to 100,000. This one meant to be net operating working capital. Okay. Now, the nature of this one. First of all, you just hold cash on hand. I am a restaurant owner, right? So I have cash 100,000. So what I need to do? I need to put this one to purchase my inventory. For restaurant, 100,000, I go to the market. Go to the market to purchase my raw material equal to 100,000 baht. See the process, right? From cash, now it changed to be raw materials. Raw materials in restaurant include what? Rice, vegetable, meat, fish, and so on. Get it right? So after we have that, okay, on day 1 that I operate my restaurant, day 1. Okay, day 1 is somewhere here, only day 1. Okay? The raw material that I put it back to my restaurant, I need to cook it to be, in terms of your accounting, you have finished goods. Okay? I cannot serve the fresh vegetable, the raw rice. Okay? I need to cook it first. After I cook it, I put on the plate and sell to customer. The customer purchases it. So I have cash come back 100,000. In fact, I have cash plus profit. But let's talk about 100,000, your initial investment only. Is it okay? This is what happened in 1 day for my restaurant. Okay? How about day 2? What happened on the second day? The process will repeat itself, right? So after I have cash back in day 1, I just go to the market in the morning of day 2. Go to purchase what? Raw material again, and then cook it to be finished goods. And serve to customer. The customer purchase all of that, assume that. So I get cash again, 100,000 at the end or in the evening of day 2. Okay? The process will repeat itself like this day by day until at the end of year 1. Is it okay? This is what happened. Okay? So at the end of year 1 or 31st December year 1, I must get cash equal to 100,000. This is what I have. This is its nature of net operating working capital. Okay? In Thai, net operating working capital is very straightforward. Okay? In Thai, net operating working capital we call as เงินทุนเรียนสำหรับการดำเนินงาน right? You put cash to invest and then you get inventory, you sell to your customer. After that, you get cash back. After you get cash, you just purchase the second round of inventory. Okay? This is a very same concept that we discussed in financial statement analysis. In case you remember, this is operating cycle. Okay? Now, this is the point of end of year one right here. Okay? Let's look further. Okay? After year one, let's assume this. After year one, go on to the next year, year two. Okay. I expect that I will have 50% more of customer. Okay? If I have 50% more of customer, the amount of net operating working capital cannot be 100,000, right? Proportionally, what must be the amount of net operating working capital for the second year? Not 100,000, but 100,000 and 150,000. Is it okay? Proportionally, like this. So, in terms of the company must invest, okay, another 50,000 in year one. Is it okay? After you invest 100,000 in year zero, now for 1 year it is not enough, so the company need to invest extra 50,000. So the project has NOWC equal to this one. Okay? Investment here, you can call it as change, okay? Change in net operating working capital. Okay? After we have 150,000, what happened? We are going to use it day by day again, right? Day by day, day by day, day by day, until end of year two. What happened at the end of year two? The firm expects to get cash in terms of net operating working capital 150,000 back. Is it okay? 31st December, same process. Okay. Now, let me assume further that, okay, next year, year three. Year three. I see that another new restaurant opened nearby. I have competitor. I expect that my sales or my customer will be reduced by 20%. So the question is, what must be net operating working capital at the end of year two to be ready for the operation in year three? Is it 150,000? No. It must be reduced by 20%, right? Or it reduced by 30,000. Okay? So the company must reduce, okay, investment in net operating working capital by 30,000. So the company will have only 120,000 of net operating working capital to continue in year three. Again, what happened at the end of year three? Okay, at the end of year three, we must get cash 120,000. This is what we have in terms of NOWC. And let's assume that this is the last year of the project. Okay? If year three is the last year, what we have 120,000 here, it is what we call return on NOWC. This is the nature of net operating working capital, step by step, like this, until last year. See the nature, right? This is what we have. Now, when we look at the amount, we are going to put in the cash flow estimation related to net operating working capital from my example here, okay? There are 3 of them, year by year, like this, okay? So, year 0, okay? Year 1, year 2, and year 3, okay? From the numbers that I put in for you, this is what I have. In year 0, we invest 100,000. Okay? This is initial investment in NOWC. In each year, we have change, okay, in net operating working capital. Remember, right? The company need to invest 50,000 more at the end of year 1. Okay? At the end of year 2, the company reduced investment in NOWC by getting back 30,000. Okay? And last one, the company get 120,000 back. This is return on NOWC. Okay? So these are cash flows related to our NOWC in just the project I just discussed with you. And all of these three, they belong to different sections of the cash flows. Okay? This is the first section. This is second section, part of the second section cash flow. And this is the third section of the cash flow, TCF or CF. This is CF0. Right? This is what we have. Okay? I need to discuss NOWC first because it will relate to all the cash flow sections. This is what we have. Now, how can you calculate net operating working capital? For net operating working capital, by accounting definition, you have what you call net working capital. So in accounting term, you call this one net working capital NWC. It just equal to current asset minus current liabilities. So you have current asset minus current liabilities. Now, for finance people, we are not going to use total current assets and total current liabilities. We will use only net operating, okay, or NOWC, come from operating current asset minus operating current liabilities. So we put OCA minus OCR. Okay. So what are typical items in OCA? Okay. In any business, you need to have cash, accounts receivable, inventory that relate to your operation. Okay, sometimes you have some prepaid expense as well. This is what we have. Okay. For operating current liabilities, what you have like accounts payable, you have accruals, you have deferred. Okay. So these are typical items in operating current asset and operating current liabilities that you need to subtract each other to get net operating working capital. Then I am going to discuss operating cash flow, the second section of the cash flow, what you need to calculate for me. Okay? Okay. The next section of the second section of the cash flows, operating cash flows. How do you calculate that for operating cash flows? Okay. Go back to here. Here. Now, for operating cash flow year by year, the second section, okay, operating cash flows. The easiest way for finance people, we just borrow the pattern from income statement, which start from operating revenue or the revenue from the project only. Okay. Subtract cost of goods sold, so you get gross profit, right? After that, you subtract other cash operating expense. Also subtract non-cash with this, which is depreciation expense. So you get operating profit. For a very small company or small project like this one equivalent to EBIT, okay, earnings before interest and tax. This is the pattern of the typical income statement, okay, right? This is what we have. After that, okay, according to income statement, when you arrive at EBIT, earnings before interest and tax, you will subtract interest expense after this, right? But for the project calculation, the cash flow in the project is operating cash flows. We are not going to deduct interest expense because interest expense is not considered as operating expense. Interest expense is non-operating expense. So we are not going to deduct interest expense at this moment. So we will jump to deduct tax immediately. Okay, so we deduct tax immediately. After that, we are going to have something very close to net income. But this one, finance people never call it as net income. Because when you call it as net income, you must deduct interest expense already. So to make sure that all of us finance people, we know that this is the net income that did not deduct interest expense. Okay? Finance people will call this one in another name as net operating profit after tax. By chart, sorry, tax. Okay. This is what we call NOPAT by chart. When someone refers to the term NOPAT, okay, the easiest way for you to think about NOPAT is what? Think about income statement. When you know income statement, you just calculate according to income statement only if you put interest expense equal to 0. When you put interest equal to 0, net income that you calculate from your income statement, you are going to call them as NOPAT, net operating profit after tax. This is what we do. After we get NOPAT here, very similar to net income, right? Is it the same amount as cash? Can you say that net income on NOPAT equal to cash? Is it no? Why? You deduct depreciation expense, right? Why we deduct it? We need to deduct it because according to the taxation rule, we can deduct it to have a lower profit to calculate tax, right? We deduct it to the purpose of calculating tax. But for finance people, when you calculate net present value, you are not going to compute present value of NOPAT on net income. You need to change this one to be cash. Okay? So how can we do it? In order for you to change it into cash, first step, okay, you subtract it, right? So to make it close to cash, you add it back, you add depreciation back. Okay? And what else that you need to add or subtract? The one that we discussed earlier. Plus or minus your change in net operating working capital or change in net operating working capital. This is short term in nature because we need to have more or lower amount of inventory, account receivable, and so on. So we look at the change in short term items. Also, we need to look at the change in long-term item. We have plus or minus change in non-current asset. This is long-term nature. It is possible, right, that when my project go on, we need to purchase more refrigerator, we need to purchase more building, we need to purchase more equipment. Okay, or we can sell some of them out because we expect lower customer. So we do not need that many tables, so I just sell them out. Okay, so I get plus or minus from this one. Sometimes for this one, we can call this one as capital expenditure or capex. Okay. It is what we purchase for non-current assets. Finally, you get operating cash flows. Year by year. This is how you calculate it step by step like this. In fact, you have all of that in your lecture note. Okay. See that, right? Now, another way for finance people to compute operating profit here, okay? Let's go back up here. Okay. For finance people, we may reclassify these cash flows, okay, or these expense in another way. Okay? We just simply classify them as variable costs and fixed costs or non-variable costs. Okay. So again, when we start from operating revenue, we subtract this one, and we also subtract depreciation one more time. Oh, sorry, we subtract depreciation, similar to the left-hand side process. So we are going to get a very same amount for operating profit here. This is what we have. Okay. Either one will give you the same answer. Okay. It depends on the data you have on hand. Any question for operating cash flows?
ตัวแทนนะครับเราใช้20%
Of operating profit.
ของตัวนี้เลย
Yes.
ไม่ต้อง
No. For tax here, if the tax rate equal to 20%, when you have operating profit 1,000 baht, your tax 20%, tax will equal to 100 immediately. Okay, do not need to adjust for interest expense because operating cash flow never talk about non-operating expense. So calculate tax based on this amount right away. Okay? Now the last one, the third section of the cash flow, terminal cash flows. Okay? Where is terminal cash flows? Go back here. Okay. Terminal cash flows, it will be here, right? Terminal cash flows. The third part, okay, terminal cash flows. The easiest way for us to understand this one, just think about your investment here. Okay? And relate it back here. Okay. Remember what we have here. Invest in non-current asset, right? My restaurant, I purchase building, land, equipment, and so on. Okay? Now, it is the end of the project life. I do not need to have those building equipment any longer. So what I should do here, I will sell them out. Okay? When I sell them out, what I will have, okay, I will get the market value of our non-current asset. or PPE, right? Okay? After that, you just subtract or add tax after that. Okay? In case you gain, your tax will be negative. In case you lost, your tax will be positive amount here. Okay. One more thing for terminal cash flows. This is what we already discussed. So you have return on net operating working capital. Again, in case you gain or loss, you have to plus or minus tax as well. And that's all. This is terminal cash flows. Okay. And the only way for you to be able to understand what I just discussed here, these are all concepts only, no numbers. Okay? You are going to calculate one project cash flow for me after this. Okay? Let me show you this one first. I will come back here. Okay? On the following page, oh sorry. Here. Okay? On page 7, you have this project. The project life equal to 4 years. You have the data for initial investment here. The data for annual operating cash flows here. The data for terminal cash flows here. And cost of capital, you use 17% to calculate NPV finally. Okay. I prepared the table for you to fill in all the numbers. Okay. First part, initial investment here. Okay. Next one, you can calculate NOWC from here. Okay. Then you have income statement until you arrive operating profit and NOPAT. After you get NOPAT, you just calculate it to be operating cash flow. Add back depreciation, change in net operating working capital, change in PPE. Okay? The third section of the cash flows, terminal cash flows, is here. Market value, subtract tax. You calculate, you compare market value with book value, so you get gain or loss, compute tax here. Okay. Remember to have return on NOWC. Finally, terminal cash flows here. After you have all the cash flows, you must calculate NPV and so on. Okay, this is what you are going to do. Okay. After the break. But before we take a break, let me tell you one more thing. In US, okay, for depreciation method, you may see the depreciation method called MACIS. This is the depreciation method in US. They will provide you the table like this. The way to calculate depreciation, in case your non-current assets belong to 5 years depreciation method, you are going to use the percentage here year by year by just multiply the percentage with the acquisition price. For example, you get equipment 1,000 baht. So the depreciation will be 20% off 1,000 baht. Okay? Next year, 32% off again 1,000 baht. So you put your initial cost multiplied by each percentage. You get depreciation year by year for MACIS. This is a very straightforward way. The table will be given like this, and then you calculate it. Okay? Okay. Take a break first, okay, and come back, start to do this case, okay. เฮ้ยเฮ้ยเฮ้ย
ร้อยร้อยเล่น EP 33 EP อีก44
ไม่สี่ต้องคูณกับร้อยเว้ยเพราะเขาไม่ได้เอาแครี่กับไม่เอาสี่
บวกกันทั้งหมดเท่ากับร้อยเขาว่า
มันก็คือมาจากร้อย
นี่แสดงว่าเราต้องคุยกับตัวที่มันดีแรกถ้าแบบมันไม่ได้
ปีเนี่ยปีที่ใช้นี่ไง20 ปีแล้วก็ดูทำไมไม่21
ว่า
ตัว
ติด EP เลยเป็นคอนเฟิร์มเนี่ยเพราะว่ามันเป็นร้อยอย่างเงี้ยมันก็คูณกับ amount
ไอ้นนท์ยังไม่ได้